Joining us now, Ann Walsh, Chief Investment Officer at Guggenheim Partners Investment Management. Scott sat there so many times over the years. That was a shocker for all of us, and we
Scott Minor, passing away.
Our regards to the family and his husband and everyone else. But great to have you on.
Thank you.
I don't know whether the latest inflation number informs the same opinion with you, but when we talked to you previously, that number was not out. So a bigger than expected drop in PPI.
Indeed, yes. It actually adds to our narrative, I think. We, as you mentioned, are predicting the recession to start mid-year. And it's because we think the Fed is continuing to push on the QT accelerator and continuing to drive down inflation, as well as labor costs and all the other elements that lead into that story. We're a little ahead of our market peers in terms of our viewpoint. Our market peers are sort of anticipating a recession maybe at the end of 2023, maybe into 2024. But we think that this quantitative tightening, which is both a combination of rate hikes, which we anticipate the Fed will continue. Certainly the market's priced into 25 basis point rate hikes this year still. And of course, the addition of the quantitative tightening coming from the reduction of the balance sheet will also help to drive down prices further. So all this is sort of feeding into our narrative for this year.
And the depth of the recession, how's it going to feel? Is it going to feel soft? Is it going to feel hard? Is it going to be short-lived? Is the market already discounted a mild recession?
So the market's pricing in a mild recession, and some market participants are still anticipating that we actually avoid recession entirely, sort of the Goldilocks experience. But that's not our narrative. We don't think that that's the place that we end up. And the more quantitative tightening that we see, the more we see the risk of a more prolonged and deeper recession. Historically, recessions last about a year. If you exclude the pandemic recession and you exclude the global financial crisis. And that's a normal business cycle. And so we could see that. In addition, we think that the recession, normally, right where we are right now, we would see the recession being fairly mild. But there's the risk that, particularly with the reduction of the balance sheet and the lack of liquidity that the Fed is introducing, that recession story is going to get worse.
Is it justified what the Fed is doing, or do you think they could overshoot?
Oh, I think they definitely could overshoot, and I'm, expecting them to. That seems to be their history, and
that's part of the calculus that they overshoot.
Indeed, it is. Yes, and I'm really looking at the quantitative tightening, the balance sheet reduction, which a lot of investors aren't really paying much attention to, and
they're just a quarter point. Half point. They're not talking about the effects of the QT, which is sort of in the background, but going on every day. Yeah.
So what do you do as a result? Do you wait? Like, this is not a time to buy, even though prices have come down so much, because you think there's more pain to come?
So I think this is a time to reposition portfolios. As a longtime fixed income manager, there's one thing that Fed has done for us, and they put the income back in fixed income. Yeah. So right now there's a very good time to be in investment grade fixed income relative to equities. Equities haven't repriced yet. And as we go through a recessionary timeline, we will see that. But certainly right now, the fixed income story is a good one. I would be avoiding the lowest credit quality, high yield and or bank loans at this point in time, because we haven't seen the default series start. We haven't seen that cycle begin. And as we go through a recession, even a shallow one, defaults will rise and the risks will get much worse in the lower rated credits.